In this video, we are going to be looking at the Baltimore rental market for multifamily properties. As you can see, we have the Baltimore MSA, Metro Statistical Area, drawn out as per the CoStar supply side tool that I like to use. And we can see that we have Washington, D.C. right here. So we can see that Baltimore is the MSA that is adjacent to the Washington, D.C. market. All right, so that kind of gives you an idea where it is located. So let's look at our filters that we do, like we do for every one of these videos. We are excluding all corporate, all military, all senior, and all vacation. And we are including only market and market affordable so that we are only looking at conventional apartments. If we look at location, we can see that we are in markets. Market type is MSA, Metro Markets, and we are looking at the Baltimore, Maryland market. All right, so let's go see what the analytics is telling us. So we have here our supply snapshot for the Baltimore, Maryland MSA. We can see that there are 2,788 properties, totaling 209,420 units, and there are still 4,283 units under construction. Now, what is not a very good sign at this point is that in the last 12 months, so in 2022, there were 3,152 more units that went vacant than what was delivered. So I'm sure we're going to have deliveries during that 12-month period. I have not looked yet to see. But in addition to what was delivered vacant, another 3,152 went vacant. So there appears to be an exit stage left in this market, but we'll have to see where that is occurring. Right now, we are looking at all Class A, B, and C properties together. And we can see that with this negative absorption, the vacancy rate has ticked up from 4.3% all the way to 6.7%. We can see that there's still a very slight year-over-year increase in the rental market, but my guess is with this much negative absorption and vacancy ticking up this high, that we're going to see some rent decline, but we'll see where that occurs. Okay, once again, we are not looking at the capital markets, only the space markets. Let's scroll down and look at our long-term occupancy average to see where we might put this on the market cycle chart. We can see that the market likes to be at 94%, so that's pretty high occupancy, fairly low vacancy of 6%, and is currently sitting at 93.27, so below that long-term occupancy line, albeit only a little bit, 0.73% below the long-term occupancy average. One can argue that it may actually be on that long-term occupancy average line. But with this much absorption, let's see what the data is showing us. So here are the rent analytics for the Baltimore, Maryland Metro Statistical Area. We will not be looking at asking rents. That is what the ownership is asking. We are going to be looking at the effective rent, which is what ownership is collecting. So we can see that in first quarter 2022, they collected $1,568, went up to $1,594, and then started that trend downward. So let's see if our deliveries and our absorption tell us the same story. So if we come over, we can see it didn't deliver very many units, delivered 205 units in the first quarter. Oh, but look at the negative absorption. So the negative absorption actually started in the fourth quarter of 2022 and has just consistently happened ever since. So there really shouldn't have been an uptrend in rents other than the fact that our occupancy was above what the long-term occupancy average is for this market. So these negative absorption numbers could be stabilizing the market back to the long-term occupancy average. So rents climbed until they got there. And as we saw, they started declining from the third and fourth quarter. So these larger numbers in the third and fourth quarter, even though we did have some delivery, show an indication of that. So the fact that we had small numbers of deliveries has helped this market, saved a little bit from going too far down, but we can tell that the negative absorption is not stopping. So we'll see how far this can actually go down. So let's go take a look and see which asset class, if any of them, are bringing this down, or if it's shared across all three: Class A, Class B, and Class C. So let's go look at Class A first. So here is our Class A data. We have 183 properties totaling 40,975 units. We are looking at effective rent. They started at $2,094 in the first quarter of 2022, went up to $2,153, and then the downtrend started. So down to $2,103 in the third quarter and down to $2,060 in the fourth quarter. We can see that we are lower in the fourth quarter of 2022 than we were in the fourth quarter of 2021. And that negative rent growth shows that. So something propped up the market slightly, because we did show a positive trend in rents. So it's not the Class A's that are propping it up. The Class A actually dragged it down a little bit, but let's see what our deliveries and absorption tells us. See if we get the same story. So a little bit of a different story. We had some absorption, which explains the rental increases in the first and second quarter of 2022, even though we had some deliveries, but we had more deliveries or more absorption than we did deliveries, which is good. But then in the third quarter, the trend started down. So we should have seen an increase in occupancy, and we did. And then as the numbers started to fall and absorption started to wane, the occupancy started to decrease. As those occupancies decrease, so do the rents, and that showed it. So the Class A space is reacting appropriately to demand versus supply in Baltimore, Maryland. Let's see what Class B tells us. Here are our Class B rents. We can see that we have 657 properties totaling 79,046 units. Looking at effective rent, we started at $1,573, went up to $1,591, down to $1,583, down to $1,570. So same trend we saw with the overall in the Class A. The Class Bs started their downtrend in the third quarter. Let's see what deliveries and absorption tells us. So just like the overall, we have negative absorption all the way back to the fourth quarter of 2021, where we did have some deliveries, albeit not much. But it definitely looks like the B-class properties are dragging this market down. But we are going to need see more negative absorption than this. So it tells me that the C's probably are also being dragged down. So the Class A's may actually be the darlings here. This definitely isn't being propped up on the rent side, because we saw the numbers declining, which tells me that we're going to see the C's in rent growth all four quarters, but we'll see when we get there. Hopefully we don't see absorption like this, but depends on where that occupancy is. We can see here that occupancy has declined and has come down to about what that long-term occupancy average is. So the fact that we had some rent growth in the front and then started declining makes sense based on where these occupancy numbers currently are. Okay, can't fault the owner for bringing the market to a stabilized number at that long-term occupancy average. So let's go see what the Class C space tells us. Here is the Class C data. There are 1,728 properties, totaling 88,367 units. We are looking at effective rent. Rent started at $1,283, went up to $1,300, went up to $1,310, and then very, very slightly down to $1,309. So as I expected, we did get rent growth at least through the third quarter. Fourth quarter, we had a very slight decline. One can argue actually stabilized between third and fourth quarter. Let's see what absorption tells us, because we should not see any deliveries for this asset class. We do show some under construction. That's going to be erroneous information. Basically, you do not deliver Class C properties. You deliver at least B, but it's probably in a C or C minus area. So CoStar is putting this here. And as suspected, as we've seen with all these other markets, the negative absorption has ensued. And it looks like we get down to about the long-term occupancy average right around the fourth quarter, which explains that little slight tick down that we saw, albeit I would have liked to have seen it a little bit more. But once again, the overall, the Class B and the Class C have been in negative absorption since the fourth quarter of 2021, which means the A's propped it up slightly, and the rest of the market has been trending downward ever since on the demand side. So this is showing there is no demand for these units until it gets to a stabilized rent where the renters are going to be happy moving back into the units again. So looking at the Baltimore, Maryland metro statistical area, this confirms that they are definitely on that long-term occupancy average between phase 3 oversupply and phase 4 recession. I would even trend it slightly below that long-term occupancy line, but not quite to that first point going down. But it is definitely trending that way. The good news here, there aren't a whole lot of units left. There's only about 4,500 more units to deliver. Hopefully nobody else puts anything under construction at this point so that this market can stabilize. It doesn't look like it's going to do too bad with the number of units that are still left to deliver. So this market may go down about 5 or 10%, but not as bad as some of the other markets we've seen in the Sun Belt. So this concludes the Baltimore, Maryland metro statistical area rental update for multifamily properties, more specifically conventional multifamily properties. Stay tuned tomorrow, the final day of the week, where we're going to take a look at upstate New York and look at the capital of Albany. I will see you guys tomorrow.